Precious metals and sovereign debts may not be friends, but they're no strangers to each other either. On May 19th, silver sold off 5% in about 30 minutes in early trading on some surprising news. Bond yields are up, and they're up in a big way. Treasuries, the Bank of Japan, and precious metals are telling us something about how June could go, but they're also telling us something about the next 12 to 24 months investors will want to hear. The Bank of Japan meets on June 16th, and a rate hike is increasingly on the table. Their April vote was divided 6-3 to hold, with 3 members already arguing for a hike. U.S. precious metal investors care for one reason. Japan is the largest foreign holder of U.S. Treasuries. When yields at home start to compete with what they can earn in U.S. debt, Japanese capital begins to think about going back to Tokyo. That pressures Treasury prices down, which pushes U.S. yields up, and rising real yields on U.S. debt are a reliable headwind for gold. And we can already see it happening. The 10-year JGB is already at 2.75%, a 29-year high. The U.S. 10-year is near 4.65%. The 30-year is at an 18-year high. And the federal funds futures market is now pricing roughly a 50% chance of a Fed rate hike at the December meeting. Not a cut, a hike. And that repricing is driven mostly by April's CPI report, which came in at 3.8% on rising oil costs. Most of the move in long-term yields is about the term premium. Now, the term premium is the extra return investors demand to hold a long-dated bond instead of a short one. When investors get nervous about inflation or about how much debt the US government keeps issuing, they want a bigger reward to lock their money up for 10 or 30 years. The term premium has been climbing for months. It now accounts for more than half of where the 10-year yield is sitting today. And there are 2 stories being told here, one by the bond market and one by the Fed. The bond market speaks to us in 2 ways. The term premium tells us that structural risk is growing, a tailwind for gold over the long run. But over the short run, we have capital rotating into bond markets to capture rising real yields. On the other hand, the inflation reports and shifting market expectations on rate hikes is a headwind for gold. 2 days after the Bank of Japan meeting, the Fed releases their infamous dot plot with rate projections on the 18th. In spite of that, if all goes as expected, gold prices may not move much. The real risk is in the surprise. The market does not price itself based on what happens. It prices based on expectations, and the market has already priced in a Bank of Japan hike and a hawkish Fed. If we get a jumbo hike from the Bank of Japan or a statement from the Federal Reserve that makes a December hike meaningfully more likely, that could take gold lower in the back half of June. And silver would move harder and faster because silver always does. If a meaningful drop occurs, it could even shake out some of the leveraged money that's built up positions in the gold market over the past year, amplifying the downside. But there's some evidence to suggest that the worst case scenarios are tail risk events, low likelihood of occurring. Kevin Warsh just took the chair of the Federal Reserve on May 13th. He has publicly argued there's room to cut, not hike. Even granting his stated independence, the institutional starting point has shifted a little. Private equity and commercial real estate loans are built on a variable rate model that gets refinanced periodically. There is a wall of refinancing coming in the next 18 months for debt that was originally issued at much lower rates. Hiking rates now will compound that problem directly, and it's no secret that fund managers, banks, and prominent CEOs have been flagging this as a top risk we need to mitigate for months. This specific rise in inflation, meanwhile, is almost entirely supply-driven. That means the Fed can't really fix it with a rate hike anyway. The Fed's toolkit is designed to manage demand-side inflation, too much money chasing too few goods. It's not built to handle supply shocks or oil shortages. The Fed's choices aren't pretty. They can either hike and worsen the private equity and commercial real estate landscape, knowing the hike does nothing about oil prices anyway, just to show they're serious, or they can hold and let inflation run while praying the oil shock resolves before inflation expectations anchor to a higher number. The least expensive path, politically, is to use incremental tools and jawbone to look busy and buy time while hoping the Middle East gets sorted out in time. But the Fed's no-win situation has some meaningful ramifications for precious metal investors. It's possible we get a rate hike, but given where inflation is coming from and how that would compound problems in multiple other areas, it's hard to imagine it would achieve any results our new Fed chair could brag about.
Then, in 1973, the big Middle East producers cut off oil shipments to major consuming countries.
The oil embargo of the 70s is a historical parallel to today's situation. The Fed couldn't really fix supply-side inflation without crushing the economy, and gold went from $35 to over $850 in that decade. And if we're looking to history to guide us, the bull cycle of the early 2000s gives us some unique context. Gold ran from $281 in January of 2002 to an average price of $1,688 per troy ounce in 2012, a 500% return over 11 years. Inside that run, 34% of months were negative, meaning the average price was lower than the month prior. And the drawdowns weren't small either. June 2006, gold dropped 11.7% in a single month. August 2008, averages were down 10.7%. Gold spent the entire 2008 liquidity crisis getting sold off with everything else, and then doubled over the next 3 years. Looking at where we are now, gold averaged $5,019 per ounce in February. March's average was down 3.1% from that, and April was down 2.8% from March. If June lands somewhere in the low 4,000s, that's roughly a 15 to 20% drawdown from the peak in February. Sharp, but well inside what the 2002 to 2012 bull market handed investors on multiple occasions. And after the corrections, the rally carried on. And a big correction could be structurally healthy. Gold went 14 months between January 2025 and February 2026 with only one negative print, and that one was less than 0.5%. That kind of one-directional run builds up leveraged positioning. A flush in June could shake out the momentum traders and reset gold to trade on fundamentals, central bank demand, real yields, fiscal concerns, rather than on flows with a foundation built on sand. That's healthier for the asset class over the next couple of years, even if it stings a bit on the way through. So watch the next few weeks to see what position the Bank of Japan takes on the 16th. The Fed's rate expectations come out 2 days later, on the 18th. Watch for surprise, not the baseline, and for the longs. The conditions that drove gold from 2023 to 2026 are still here. The US debt has not shrunk or gone away. Congress is still spending money they don't have. Inflation is sticking around like an unwanted guest, and we're still seeing robust international demand. A bond market shock could give us an ugly June, but it doesn't mean the cycle has ended. The last bull market is pretty clear on what cycles like this look like in real time. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.